I'm Rawdon Christie and welcome to NBR This Week, a look back at our top rating stories from the past week. As Fletcher Building shareholders listened to presentations at their annual meeting this week, the value of their company sank more than 7%, wiping $350 million from its market capitalisation. The culprit was a profit warning delivered before the meeting, indicating earnings before interest and tax would be between $630 and $680 million for the 2019 year. Chief Executive Ross Taylor said the previous guidance placed the company at the top of that range, but they'd eased back slightly given the present trading conditions in Australia. Since Tuesday, the share price has dropped further, 16% since the announcement, wiping a total $776.5 million from its market capitalisation to trade at $4.64 on Friday. Mr. Taylor said the company's strategy would now be focusing on stabilising the business.
Firstly, in New Zealand, we're seeing residential consents run at around 30,000 consents per annum, which is slightly down on previous years, but much as we expected it to look like. Activity levels remain robust, especially here in Auckland, but we think this is now plateauing and there are signs that the Auckland market will pull back slightly. Looking forward, with continuing supply-demand imbalances, a solid New Zealand economy and immigrations not being overly curtailed, we continue to feel the present levels of activity are sustainable, at least for the medium term.
Our columnist, Shoeshine, argues that rather than knock the NZX and the capital markets for letting Kiwi companies flee to the ASX, Kiwis should celebrate that the gatekeeping broking houses here are not taking on poor quality listings. Shoeshine says some of our worst IPOs have polluted the ASX rather than the local exchange. What has driven many local companies to Australia, says Shoeshine, isn't the dynamism of the ASX, but the relative supply of optimistic, often uninformed, moneyed idiots. Somehow the Aussies haven't spotted the pattern of the non-success rate of small Kiwi companies choosing to play away from home, according to Shoeshine. Analysts have mixed views on whether Trade Me should accept an indicative offer from Apex Partners to acquire 100% of its shares. The company announced the potential buyout on Wednesday, saying the London-based investment firm made a preliminary, non-binding indicative proposal to acquire all shares at a cash price of $6.40 a share. The offer values Trade Me at $2.5 billion. The proposal might have come as music to the ears of some shareholders, as Trade Me has struggled to achieve its former growth in recent years as it faces increasing competition. However, analysts are divided on whether the offer is the best it can get. NBR's Grant Walker spoke to Devon Funds Management Chief Investment Officer Mark Brown.
Well, we'd like to maximise for our investors the price we get. We think that the business is a great New Zealand business and should go to premium. Currently is at par, so let's leave it at that.
First NZ Capital has upgraded its rating for the A2 milk company from neutral to outperform, following the dairy company's AGM earlier this week. A2 posted a 40% revenue boost over the first 4 months of the financial year before the meeting, which saw all of its resolutions, including those relating to director pay and new Chief Executive Jane Herdlicker's role, approved. The broker described A2's performance as solid, adding that its execution continues to impress. And although risks remain, such as Chinese regulation, these appear, quote, decreasingly likely to force abrupt changes to the business model. First NZ Capital has lifted its underlying revenue forecasts for the company modestly for this year, although it has reduced its 2019 to 2021 revenue forecast by 1% to 2% on a reported basis. It says while detail remains thin on aspects of Chinese regulation, the company, quote, is doing a good job of the things that are within its control. RCR Infrastructure NZ Limited is continuing its part of the $3.4 billion Auckland City Rail project, even though RCR's ASX-listed parent, RCR Tomlinson, has gone into administration. Administrators at McGrath-Nicholl say in a statement, the Australian firm had been in trading halt since November the 12th and had not been able to secure more finance. Investors had just injected $100 million Australian dollars into the company, which completed a capital raise in August. According to City Rail Link, the contract with RCR for the joint government and Auckland Council project is worth $7.5 million. CRL executives were to meet the receivers to discuss the ramifications of the parent company's administration. In an interview with NBR before the news of the administration broke, City Rail Link Chief Executive Sean Sweeney said costs for the project were likely to rise and he was reviewing costs and inputs.
All we have is estimates that we'll put together, on the client side. The numbers will not really crystallise until we have the bids in for the two major procurement pieces we're doing, and it's only then, and that'll be March, April next year. That'll be the first time we have some real line of sight on what the final cost should be, because up till then it's been largely made up of estimates.
CRL has just won New Zealand's highest sustainability accolade, the Sustainable Business Network's Transforming New Zealand Award. Looking ahead to next week, Shoeshine notices cash is king has been banded around a fair bit again, so she canvassed a few local fund managers to see whether they're holding more cash than usual. So what's the answer? You'll have to wait till Monday to find out. So for more on that and other stories, head to our website and have a great weekend.
To unlock your 2 free articles a week, head to nbr.co.nz.